NVIDIA stock is down in the last 2 days. They have guided lower. They're saying demand has decreased. Cryptocurrency prices being down doesn't make it as profitable for crypto miners. Therefore, all these things are happening. It's probably all true. But I want you to remember this story. Let's use our software to evaluate NVIDIA. So let's pull up the software. If you have the software, please follow along. If you don't, it's less than a cup of coffee per day. Guys, less than a year ago, the stock was at 345, hit a low of 144 in the last year, but it's currently at 169. This is what I mean about stocks, guys. Stocks go up based on enthusiasm and go down based on people not liking it. But nobody saw anything wrong with NVIDIA. Go look at our videos in the past about NVIDIA. People literally saying, you guys don't get it. You're so stupid. Now, all of a sudden, NVIDIA's like, well, wait a second. We're actually having lessening demand and things like that. My goal as a value investor, if you're new to this channel, I'm trying to explain to people that you should look at companies based on a historical perspective, make reasonable assumptions about the future, and buy at a discount, aka a margin of safety, on the valuation based on that. I use my stock analyzer tool in our software to input my conservative assumptions and see what to buy the company at. Now, all of a sudden, you see all these brokerage houses downgrading. They're reacting to the news as opposed to being anticipatory about the news and saying, wait a second, is it possible for demand to stay this high for so long? Now, I'm called a FUD. I'm called a guy who's being negative and, oh, you don't see the future. Yeah, you're right. I don't see the future of it being that great because eventually things slow down when markets go in cycles and a company can't grow 20% a year forever. That is just literally impossible to happen. So I want to wait until the market discounts a stock and says it's terrible. So NVIDIA's down in half, more than half, 346 to 144, actually 346 to 169 now. Does that mean it's a buy? I have no idea. I have no clue. My goal is to look at the numbers, use our 8-pillar process to understand the company. So let's look at our 8 pillars here. Looking at our 8 pillars, the first thing that jumps out at me is our valuation metrics. The 5-year PE ratio and the 5-year price of free cash flow. What this does is it adds up the earnings of the last 5 years and divides it into the market cap of $422 billion and gives us 84. The current PE is 44. Price of free cash flow, same thing on the free cash flow side, and they're pretty close to each other. NVIDIA has also issued some shares, not major, but they have because their stock's expensive. And when your stock is expensive, as a company, you'd rather issue shares and take on debt. Because if you issue expensive shares that are overpriced, you get the money and the stock falls. It's not like you owe anybody anything. But if you take on debt, you owe money out there. So everything else is great. High return on invested capital, revenue growth is big, net income growth is big, cash flow growth is big, and lower debt. They can pay off their debt with about 2.7 years of their average 5-year free cash flow. But the question you have to ask yourself is, are these warnings going to drive revenue and profit much lower? That's why we make a conservative assumptions. So what do? Well, we have this community here of thousands of people. You'd go in there, you talk to people about NVIDIA. Hey, what are you thinking? What are you seeing? That's a great way to engage people and get an idea of what people are thinking about NVIDIA. But more importantly, do your own research. So 1, you can contribute to the conversation. And 2, so you can make your own decision. That is what I do about every single of the company I invest in. I sit there and determine my own model. And then I go out there and read articles and people's opinions for and against the company. Sometimes the ones that are against it and for it are completely irrational and they're based on complete emotion. Discard them. I want to look at the facts or what I perceive to be more grounded assessments of the situation. Because we don't know what the facts are because the future is unknown. Every investment's a present value of all future cash flow. But if we 100% knew for a fact what the future is, we'd always get the same returns all the time. So let's go to our stock analyzer tool. This stock analyzer tool is the most popular part of our software. What it does is it takes a factor in future revenue growth, future profit margin, future free cash flow, assigns a multiple to the earnings and cash flow. You type in your desired return and it spits out what you should pay for the company based on those assumptions. It does not factor in the balance sheet, but it's a good starting point to determine if you should do more research. Because if the company comes up all green or partial green, you know you're close based on your assumptions. So go validate your assumptions and go figure out if it's a company you want to invest in. So when we're done with this video, if you need to go back and rewatch the stock analyzer tool, I highly, highly encourage it. It is so popular within our software. People use it every day. I use it for all of my analysis for all of my companies. Whenever I go look at it, it's super important. So let's start to evaluate. First things first, I'm going to do a 10-year analysis. This drop down allows you to do 1 to 20 years. First thing, revenue growth. So they've grown like crazy in the last 10 years, 23.8%. Even more so in the last 5 years, 28.1% a year. Last year, 53%. Is that sustainable? I don't know. In fact, they could drop. Over long periods of time, I don't know where they're going to go, but I'm going to make a quick assumption here. Let's go crazy. Negative 2% growth for the next 10 years. So the revenue is going to go down 2% a year for the next 10 years. I'm going to do 2% for the middle and 6% for the high. Again, I'm being super, super conservative from what I perceive to be, without doing any research on NVIDIA, what it could be. Because if the numbers all come up green, I'll be excited and go, okay, I need to go figure out if these assessments are actually accurate or not. Profit margin. Now, profit margin is probably more likely to stay up, but let's assume a little discount to profit margin because they have to unload some bad inventory and probably make some shorter term investments in their business. So the last 10 years, they've done 27%. I'm going to do 23, 25, and 23, 26, and 29. Profit margin, it's been pretty consistent. So I'm going to do 24, 26, and 28. Now, PE. Guys, PE is based on growth potential and moat. If we believe these growth potential numbers, we're going to want to go very low on PE. I'm going to say 12, 15, and 18. Because I do believe if it's able to grow 6% a year, because keep in mind, the chip market is going to grow, projected to grow 12.2% a year for the next 10 years. So I would give it a higher multiple because we're leaving some food on the table here. And I'm going to do the exact same thing with free cash flow. Now, finally, guys, desired return. I'm doing 15%. And the reason being is I'm really guessing here. I don't know what these growth numbers are going to be. I want to give myself a little bit more margin of safety than I usually do. I usually put in 12.5% because it beats the market of 9 or 10%. But I'm going to put a little bit more in here. You might be like, okay, is this too conservative? Maybe it is. But we'll change some numbers here in our second go around. So after I'm done hitting analyze, I'm going to do another go around on the stock analyzer tool, making slightly more aggressive assumptions. So I hit the analyze button. I scroll down, all red. And they're red by a lot. I have a low price of 20, a high price of 50, and 30 in the middle. Oh my Lord, that is very low. I get that. So let's go change some assumptions above. Let's go with 3, 6, and 9%. Nope, sorry, 3, 7, and 11%. Profit margin, all those ones I'm going to keep the same. And I'm actually going to keep my desired return same 15% desired return because I'm now being more aggressive. Hit the analyze button. Guys, this is why you should be concerned. Even on those 11% growth assumptions, the high price is $70. So for this company, be very cautious. It still seems overpriced to me. I appreciate your time in this one. If you like this video and want to learn more about our 8-pillar process in more detail, please click the next video above and subscribe to our channel. Thank you very much for your time.